If your business is in financial trouble, choosing the wrong option, administration or liquidation, could cost you everything. I've seen too many directors make rush decisions thinking that they're saving the business, only to end up in deeper debt, personally liable, or even being banned from being a director. Now, if you don't fully understand the differences between administration and liquidation, you could be making a choice that leaves you worse off. And I'm not just talking financially, but legally too. Now, I've worked with a director before who thought liquidation was their only option. But once we looked at the situation and understood what they were trying to achieve, we found that an administration could actually save the business. And on the flip note, I've seen directors hold on for too long, hoping for a turnaround when shutting the business down early was the best choice. And the key is knowing which option is right for you. And that is what we're going to be covering today. Hello, Chris Worden, Director First. In this video, I'm going to be breaking down administration versus liquidation, what they really mean, how they impact you as a director, and which one could be the right move for your business. So stay with me to the end, because this could be the difference between saving your company or making a costly mistake. So, thanks for joining. Now, what I want to dive into here is a crucial topic, and it's administration or liquidation. Trust me, understanding this could be the difference between your business thriving or actually taking a nosedive. I mean, people tell me all the time, Chris, I need to go into administration or I need to go into liquidation, and they don't really understand the process that they're talking about. So the first thing, let's talk about administration. Listen, picture this, right? Your company's in hot water, but there is a flicker of hope that it could be survived, okay? There's something in this business that has some value. There is a rosier future ahead. Now, that's where an administration could come in. It's like calling in the SAS to rescue your business. And here's the lowdown. First of all, an insolvency practitioner will take the wheel, right? They're not just any type of professional. They're specialists in turning businesses around. And these insolvency practitioners, if you will, they have got superpowers. In a way, you know, they can freeze creditor action. So let's say you're being threatened by creditors. Potentially there's a winding up petition in the post. An administration would give your business some breathing room. And if we go back to like the analogy of being superheroes and superpowers, what's the mission in an administration? Well, it's twofold. Either it's going to save your business, or it's going to find a better solution than a liquidation. Now remember, in a liquidation, things are broken up at piecemeal and sold on a for sale basis. So the return to creditors is normally very low. The idea of an administration is the return to creditors is higher. Now, when you go into administration, the company surrenders control to the administrator. Now, the administrator, another word for them is an insolvency practitioner. Got to be licensed. There's not that many of them in the UK. Now, I know this probably sounds scary, but it's actually a strategic move, because the administrator assesses the situation. They're going to look at the finances, they're going to look at operations, and they're going to help to develop a plan to turn things around. Now, this could involve restructuring costs, finding new revenue streams, but the key thing is a creditor can't take action against you while you're in administration, and this is going to give you valuable time to implement changes. And administration is about giving your company a fighting chance. You're not going to throw the towel in. It's putting your boxing gloves on. Now, what's liquidation? Well, liquidation is a different beast altogether. It's like deciding to sell your car for parts instead of fixing it. Here's what happens in a liquidation. You appoint a liquidator or insolvency practitioner. It's the same person as an administrator. And they close the company down, and it's like a full stop at the end of the company. And they sell all their assets if there is anything. So that could be office furniture, it could be intellectual property, it could be plant, it could be machinery, it could be a website. Literally anything that your business has as an asset, in a liquidation, it will get sold off at normally the lowest value possible. And creditors will get paid some money after a liquidator's taken their fees, because there's a strict priority of order when it comes to getting people paid, right? So the first person to get paid will be the actual charge holder, if there is one. Then it'll be the insolvency practitioner, they'll take their fees. Then there's like preference payments, so things like the HMRC will get their share. Then you've got unsecured creditors, and eventually, if there's anything left, it'll go back down to the shareholders. And a liquidation, it's curtains, like the company ceases to exist. Now, sometimes what will happen in a liquidation is a liquidator will sell the assets back to the director that started the business, or the director will decide to sell the assets of the business before they go into liquidation to them or a connected company. And I'll come on to that in a little bit. Let's break down the liquidation process, okay? So you liquidate a business if you become insolvent, can't pay your debts when they fall due, liabilities are more than their assets, or you've had some legal action from a creditor like a CCJ, and the decision's made to liquidate. Now, you can voluntarily liquidate, which is always the best, where you go out there and you find an insolvency practitioner who you're comfortable with, who you've discussed everything with, and you decide to voluntarily liquidate. Always the best option. Obviously, there's a cost to that. If you don't do anything, you'll get forced into liquidation by a creditor. And that's where let's say HMRC. HMRC are the biggest creditor to do these forced compulsory liquidations. And the story is you'll be behind on VAT, PAYE, corporation tax, or a mixture of all three. HMRC will write to you asking for them to be paid. They'll phone you, they'll text you. They may send an enforcement agent to take some assets of your business. But if you don't come to an agreement, they're going to issue a winding up petition. And that's where they go to court. You get served a winding up petition. A few weeks later, it gets advertised. When it gets advertised, everybody knows about it. People will stop supplying you. It's bad publicity, and your bank account will get frozen. Okay? But both processes end up with the same outcome. The company is liquidated. Now, a liquidator will get appointed, or the official receiver will get appointed once the business is in liquidation, whether it's a voluntary or compulsory, and they are responsible for managing the whole process. So if there are any assets left, they'll be valued by an agent and they'll be sold. Now, it's done as efficient as possible, and the idea is to raise some money so creditors get some money back. Now remember, secured creditors will come first. Any leftover money will go first to the insolvency practitioner's fees. If there's anything left, then it will go to HMRC, then unsecured creditors, and then if there's anything left, it will go to shareholders. It's very rare in most insolvent liquidations where the unsecured creditors get any money, and it's even rarer that anything goes back to shareholders. And then once it's liquidated and it's in liquidation, the insolvency practitioner is going to conduct their investigations. They're going to look as to why has the company ended up in liquidation. They're going to check. So if you've sold your assets before the liquidator has been appointed, it's going to be scrutinised very heavily, because you've essentially took assets out of a insolvent business, and they're going to be looking at whether you've done it for the detriment of creditors. So if you are looking at selling assets before you appoint a liquidator, make sure you have them independently valued. And if you're going to buy the assets, my advice to you is, when you're speaking, if you're speaking to me and you plan on doing this, I'll say, right, well, you need to get a valuation done. Introduce you to a valuing agent. And the valuer will come back with a report, and there'll be an in situ value for your assets and an ex situ value. An ex situ value means what he thinks that stuff's worth, say, at auction. In situ is the figure that he thinks it's worth to you to continue trading in the same premises, etc. And your offer to buy those assets needs to be closer to the in situ value, okay? Because if you're buying the assets for the in situ value, you can't be criticised for an asset undervalue. If you buy your assets for a lot less than they're worth, and a liquidator gets appointed, whether it's a voluntary liquidation or a compulsory, they're going to come and chase you for it. It's going to cause you a problem, okay? Now that we've covered both processes, in an administration, you'll hear of something called a pre-pack administration. It's done quite regularly, and that's where you are insolvent, obviously can't pay your debts when they fall due, liabilities are more than assets, and you go into administration, but the directors who've put the business into administration buy the business back out of administration on a pre-pack sale. They'll get an agent to value the business independently, and there'll be a marketing period of sort of 5 to 10 days where this business is open to offers from anybody. But in 99.9% of the cases, it'll be the directors that buy the business back from an administrator. They'll make an offer to the agent, it'll get accepted, and then a sale will conclude. Okay, so that's a pre-pack administration. But what I want to do now is to sort of dive into key differences, because it's crucial information for a director to understand, right? Differences between admin and liquidation. In an administration, the company might fight to live another day. There's hope for survival and turnaround. In a liquidation, it's game over for the company. Like, there's a full stop. The business ceases to exist. Now, whereas from a PR point of view, like a public perception, I think people look at an administration as a better process. It's more of a turnaround and rescue mission. Whereas if they hear a business has gone into liquidation, it's very final. Now, remember, when you're in administration, when you're in that process of administration, it's the insolvency practitioner who's running the show, okay? They've got wide-ranging powers to manage the business. In a liquidation, that insolvency practitioner is going to essentially sell off all the assets that they can, and they're going to conduct a very thorough investigation into the conduct of the director. And they both take different times. Like an administration, you might be in admin, people want it closed within 12 months really. Obviously the sale of the business, if you're doing a pre-pack admin, that'll happen right at the start, that'll happen within a couple of weeks. An administration can be extended if there's good reason. Liquidations don't really have fixed time frames. Most cases are dealt with in 12 months, but the more complex, they can run on for years. Now remember, you can get into liquidation. It's a 21-day notice period to get into liquidation. And again, how long a normal, typical liquidation will last 12 months. And after 12 months, the company will be dissolved from company's house. An administration always should result in a better return to creditors. It's about maximising value and preserving the business if possible. Liquidation focuses really on an orderly closure of the company, and assets will get sold for lower than what they're really worth in a liquidation. Liquidation is more about just winding the company's affairs up in the best way possible. And I want to dive into what's the impact on the directors, because, you know, obviously here is where it can get a bit personal. As a director, you need to know how each process will affect you. If your business goes into administration, your powers as a director are put on ice. You can't make decisions for the company anymore, but you can often work alongside the administrator, okay? And obviously, if you're doing a pre-pack, if you're looking to buy your business back from the administrator, you'll make your offer, the business will get sold, and you can regain control of that company, albeit in a new guise. So when you buy a business out of administration, you set up a new company, separate limited company, can have the same shareholders and directors of the insolvent company. And when you buy that insolvent business from the administrator, you're buying the good. You might be taking the staff over, buying the assets, buying the work in progress, buying all the fixtures and fittings, and you're starting again in that new company. Obviously, in liquidation, your role as a director comes to an end at the creditors meeting. So let's say today you ring me and go, Chris, I need to go into liquidation. We check everything out, we agree with you. Shopping list of information we need off you to get you into liquidation. And once we've got that, we'll bring in one of the insolvency practitioners that takes the appointment, and they'll send you liquidation notices to signature. So that's an important date for you, the day you sign your liquidation notices. 21 days later is when your creditors meeting will happen. And your creditors meeting is where the liquidator will be appointed. Now, that 21-day period between signing your notices and the creditors meeting, you are still the director, you're still in the hot seat. But at the creditors meeting, your control and your power and your responsibilities as a director cease to exist, okay? The insolvency practitioner might ask you some questions. There'll be an investigation. There might be some queries that we want to talk through with you. And you've just got to comply, okay? But the business closes down. Again, it's a full stop. And obviously, it can be quite emotionally tough, especially for directors who've been doing it for years, you know. I remember when I closed my business, the run-up to insolvency were really scary because I just didn't know what I didn't know. Like, I'm out there speaking to these insolvency people, and they did not speak my language. They spoke to me like I am a naughty schoolboy, or I were a criminal, or they never give me a straight answer. And I hear it all the time off directors, like, why we like you, Chris, and your team is we answer the questions. We might not give you the answer you like, you know, but we're going to tell you where we're a bit different is we'll do a bit of work first. We'll do some work without asking for a penny off you to help you understand your position in full. Not just the liquidation or the administration, but what's going to happen to you as a result of going through this insolvency process. Because guess what? There's some problems that can bite you on the arse. And most firms, they don't talk to you about it until it's too late. Because once you've appointed a liquidator or administrator, you're very hard to get rid of them. So you need to be aware of any problems before you give them any money or you give them the job. I mean, let's look at it. Personal guarantees. Whether you go into administration or liquidation, a personal guarantee should be covered carefully because that is going to come to you, okay? That is something that's going to fall on your feet if you go through an insolvency process. So you've got to have a plan to deal with it. Now, most people are really worried when you say the word personal guarantee, but the reality is lots of insolvencies result in personal guarantees getting called in. And that might be a personal guarantee against a loan, credit card, overdraft, a bit of kit, suppliers. And the key thing is with personal guarantees is you've just got to be proactive in dealing with them. Understand what your liabilities are. And when you go through an admin or a liquidation, understand that they're going to serve notice on you. And what you've got to do then is you've got to, you basically got to give you proposals to repay it. They're going to ask for it straight away, but most of these aren't going to be able to pay it straight away. So you'll be able to restructure those personal guaranteed amounts over a longer period of time. The key is don't bury your head in the sand. Another thing that's going to bite a director on the arse, whether it's a liquidation or administration, is an overdrawn director's loan account. An overdrawn director's loan account is where you owe the company money. It's the biggest problem I see today. I'm going to have to start tracking this. The amount of times we get a call at Director First on a monthly basis. I had an email the other day. Chris, my accountant has introduced me to an insolvency practitioner. I've gone into liquidation. They're now chasing me for 100 grand. Now, it's not that the chasing for the 100 grand could be avoided, because if you've got a director's loan account, you're going to be asked to repay it. What I don't like is you should be made aware of that on day one. I remember, listen, there was a little problem with my insolvency, and the lady didn't mention an overdrawn loan account, and it went on for about a year and a bit, and I ended up having to settle it. But it was stressful, and it could have been dealt with on day one. And I specifically said to this, I said, listen, I've got any other problems than the liquidation fees. No. She must have known on day one that there's going to be an overdrawn loan account. And that's what I don't like in this industry, is a lot of you out there will make mistakes because you don't know what questions to ask. And you're that focused on what's it going to cost to liquidate. That's not the consideration for you. It's what is it going to cost in total. So for you to find out if you've got an overdrawn loan account, dead helpful if you've got an up-to-date management accounting software, Sage, Xero, QuickBooks, and it's up to date, because you'll pull off a balance sheet and you'll see whether you're overdrawn on your director's loan account or not. If you haven't got that, your accountant might be operating something in the background. You could ask them. And if you haven't got that, the place to start is to go back to your last set of accounts. And in the assets, it might be in the debtors ledger. Debtors is people that owe the company money, including you as a director. Or it might be in a section called directors' advances or director's loan account. And you'll see if you're overdrawn or not. And then from that point, you could go through your bank statements and review how much you've taken out of that business since those last set of accounts. Now let's say you take £4,000 a month, and £1,000 a month is through the salary scheme, right? And you take in your head £3,000 a month a dividend. It's not a dividend. You're taking that £3,000 a month in anticipation that your business has made a profit, and your accountants can declare a dividend when they do the final set of accounts. But here's the problem. If you're going into liquidation, you're insolvent, which means, or administration, you can't pay your debts when they fall due. So you can't pay a dividend out of a business that's insolvent. You can only declare a dividend out of profits. So all them £3,000, I'm using that example, that £3,000 a month you've been taking since your last set of accounts that you call a dividend is an illegal dividend. It's not illegal that you go into prison, but it's illegal in the sense that it's going to be converted into an overdrawn director's loan account. And once an insolvency practitioner or administrator is appointed, they're going to ask you to pay it back. So back to the email about the guy who's going, my accountants introduced me to somebody and they're asking for £100,000. The fact that they're asking for £100,000 is not the problem. That's what they're there to do. An insolvency practitioner, listen, I'll say it as it is. They're not there for you as a director. Their responsibility is to represent creditors and recover money for creditors, be it the HMRC, the bank or whatever. Now, there are some really good insolvency practitioners out there, right? There are some fantastic ones. And they're the ones that give you some good director advisory. Listen, we've built a whole business and reputation on putting the director, making you aware of any problems. That's why we're called director first. We'll never break any rules, can't sweep anything under the carpet. Like with things with directors' loan accounts, if you've got one, it needs to be dealt with. And it's something that you need to be aware of before you consider any of these processes, because you'll be able to get some type of deal done on your director's loan account most of the time. So I dealt with one recently. They've gone into administration. Both directors owe about 50,000 quid. They're paying about 40 or 50,000 for the business, and they've got lots of equity. Like they have really substantial equity in both the properties. So what we've done is we did a deal with the administrator. So obviously we have about 5 insolvency practitioners that take appointments. And this one we had to negotiate over a couple of years, where the directors, they're not getting any discount, they're paying the full amount back, but they're going to pay it over to the insolvency practitioner in a couple of years, over a couple of years, okay? If you are got a mortgage, you're married, you've got some equity, you've got some personal debt, the chances are you'll be able to get a discount on your director's loan account, and you'll be able to negotiate a settlement less than what it's actually, what you actually owe the company. You know, I've done one recently where he owes the company 60,000 quid. He owns his own house, he has some equity, but he's managed to settle his director's loan account at £15,000, and he's paying it over 5 months. But the key thing is, with me, is I'll get this deal in principle done before you appoint an insolvency practitioner. Because really, an insolvency practitioner or administrator, they can only do the investigation once they are in office. But a lot of this can be done in principle. So we'll get all the information out. We'll go and speak to the relevant insolvency practitioner and go, right, well, this is what the house worth, this is what the mortgage is, this is the income, this is the expenditure, this is his disposable income. And we'll get a deal done based on you telling us everything. And once the insolvency practitioner is appointed or the administrator is appointed, everything that we've told them checks out and the deal gets formalised. So sort of when should you consider each option, you know, liquidation or administration? Well, considering administration, I think it's when your business is struggling, but it has some potential. You know, maybe you have a temporary cash flow crunch, you know, you need some protection for creditors. You know, if there's legal action that's threatening to sink the company, but you believe in your heart of hearts that the company can be turned around. It might be new management, it might be a fresh strategy. It might be that you just need to shed this legacy debt that's been built up over COVID or, you know, through the cost of living crisis. But you know you've got a core, strong business that can flourish going forward. Because an admin can sort of help maintain your workforce. In most cases, you'll take all your staff over and the goodwill of the business. Now, when liquidation might be the answer is the business is no longer viable. You know, it's ran its course. It's become insolvent. You know, the core business model might not work anymore. Debts are overwhelming. And the key thing, you've got no realistic way to pay it back. Now, in liquidation, the hole might be too deep to climb out of it and you just want to make a clean break and move on. And remember, a fresh start is sometimes the best option. Sometimes in a liquidation, you will start again, you'll start that business again in a different limited company. You know, you'll buy the assets back from the liquidator or you'll sell the assets before the liquidator takes office. Remember, if you're doing that, you need to make sure that you are paying fair market value for it. So listen, if you've enjoyed the video, if you found it interesting, ask us a question. Any comments I reply to personally. Like, subscribe to the channel. If you need somebody to talk to, the team at Director First, with no judgment, no nonsense, no strings attached, give us a call. Thanks for joining us. And if you enjoy my content, please go and watch the next video that's going to appear up here. Thanks for your time. Bye-bye.